Have you ever wondered how businesses keep their financial reports accurate when money doesn't always arrive or leave at the perfect time? That's exactly why accruals exist. Accruals are accounting entries used to record revenue or expenses before cash is actually received or paid. In simple terms, they allow businesses to record financial activity when it happens, not when the money moves. This is one of the key foundations of accrual accounting. Let's break it down. Imagine a company uses electricity throughout December, but the bill won't be paid until January. Even though no cash has left the business yet, the expense still belongs to December because that's when the electricity was used. So the accountant records an accrued expense. Now imagine the opposite situation. A company completes work for a customer in June, but payment won't arrive until July. The company already earned the revenue in June, so it records accrued revenue before the cash arrives. This is the main function of accruals, to match revenue and expenses to the correct accounting period. Why does that matter? Because without accruals, financial statements could give a very distorted picture. A business could look highly profitable simply because bills haven't been paid yet, or it could appear weak because customer payments are delayed. Accruals help fix that timing problem and create more accurate financial reporting. Now, there are two main types of accruals. The first is accrued expenses. These are expenses the business owes but hasn't paid yet, like unpaid wages, utilities, interest, or taxes. The second is accrued revenue. This is revenue the business has earned but hasn't received payment for yet. Both types ensure the financial statements reflect real business activity rather than just cash flow timing. Let's make this simple. Think of accruals like recording a football score the moment the goal is scored, not waiting until the match prize money is handed out later. The event already happened, even if the cash hasn't moved yet. A common misunderstanding is thinking accruals are estimates or fake numbers. They're not. The business activity genuinely occurred. The payment timing is simply different. Another misconception is that accruals only matter for large corporations. In reality, accruals are essential for accurate reporting in many businesses, especially as they grow. So, what's the key takeaway? Accruals are accounting adjustments that record revenue and expenses before cash changes hands. Their purpose is to ensure financial statements reflect when economic activity truly happens, not just when payments occur. And once you understand accruals, you realize accounting is really about timing, accuracy, and telling the true financial story behind a business.